My name is Dan Scicciarino. I'm the Customer Learning and Development Consultant here at RightCapital, and I'm thrilled to be here with you for today's educational webinar, specifically on transitioning a client's asset allocation in RightCapital. These are always my favorite webinars where we really get to dive deeper into a specific aspect of the projections in RightCapital. And for most of today's presentation, we're going to be looking at the impact of a very specific setting, which is the allocation method setting. So the setting, for the most part, determines how RightCapital's going to project a client's asset allocation out into the future. So we're going to be exploring all of the options there. We'll be touching on creating custom models, things like model portfolios and custom glide paths. And we'll also be looking at some of the important assumptions to keep in mind as well, that pertain to a client's investments and portfolio return. So that being said, before we dive in here, let's take a quick look at the agenda for today. As I mentioned, we're going to start by taking a look at some of those settings and assumptions that are going to have a significant impact on a client's investment returns. We're then going to dive into a client plan and review all of the different options for the allocation method setting. Then we're going to look at creating custom model portfolios and glide paths in the advisor portal. And then lastly, we're going to be looking at proposing a new asset allocation strategy in the retirement section and the impact that that will have on the Monte-Carlo analysis and the cash flow projections. As always, we will be doing a live Q&A at the end of the presentation. So, please feel free to write in if you have any questions using the GoToWebinar control panel on your screen. I will do my best to answer as many questions as I can until the top of the hour. Perfect. I am quickly just going to switch screens over to my RightCapital login. So bear with me just a moment here and we can get started. Perfect. Great. So we're going to start here in the advisor portal today by quickly reviewing some of those settings and assumptions that are going to be important when it comes to asset allocation. So the first thing that we're going to do here is dive into the assumptions area, which can be found in the More menu here in the advisor portal. And for those of us who might be a little bit newer to RightCapital, I do want to quickly explain return assumptions in general and also highlight the importance of assumptions when it comes to the output of your financial plans. The numbers that you see on screen here are essentially the projected investment returns for individual asset classes in RightCapital. So, by tailoring the interest, dividends, and capital gains here, this is going to have a significant impact on the returns that we see across all of our client plans. By default, in RightCapital, it will be set to this historical index returns option. This is a set of curated assumptions that we create here at RightCapital each year. These are based on 50 years of data for equities and 20 years of data for bonds to determine, of course, the rate of return for each asset class. But ultimately, you do have the flexibility to align these assumptions to your beliefs and your unique advising philosophy. You can choose between one of our presets here. You can choose to use the forward-looking JP Morgan assumptions if you'd like, and you can even fully customize the interest, dividends, and capital gains across the board here to really get very granular with some of these total return percentages that we see here. So this is, of course, the area of the advisor portal where we're setting the global asset return assumptions. So this will be used as the starting point within all of your client plans, but these assumptions can be tailored at the client specific level as well within the settings of each client plan. So when we dive into a client plan in just a minute here, I will, of course, show you where you're able to do that. Perfect. The other thing I want to take a quick look at here in the advisor portal is specifically the client presets, which can be found in the client settings tab here. Something to keep in mind, depending on your specific advisor portal setup, the client settings tab might just be in the upper menu bar here before the help tab. If you have some additional add-ons to your RightCapital account, it might be located in the more menu here. So just something to keep in mind there, but Ultimately, within the client settings, we can find the client presets tab. And this is the first place that we're going to be able to see the allocation method setting, which is, of course, the setting that we're going to spend most of our time looking at here today. This is going to determine how we're projecting that clients or all of our clients' investment allocation out into the future here. And the reason I highlight client presets in particular is because this is where we can set that default setting, that overall preset that's going to be used as the starting point within all of our client plans. So, of course, investment strategy conversations can be dependent on the client demographic. Are you working with younger clients whose strategy will change a lot over time, or are we working with retirees who are not going to be seeing so many adjustments? So, depending on the client demographic that you typically work with, you may want to change this at the advisor level, at the global level, here within the client presets tab. So, just a quick example for you, the default selection here is same allocation for all years. So if you are someone who works mostly with retirees, that might make sense, but you can always change to one of these other options, if you'd like, depending on the demographic that you work with. So we are about to dive into each of these options in greater detail within a client plan here, but I do recommend just filing away the location of the client presets tab here in the advisor portal. And if you find yourself thinking at any point that you might have a preference in terms of one of these options for the majority of your clients, just remember that you can always come here and change this at a global level. Perfect. So next up here, we are going to be diving into a client plan. So let me just pull up my case study here for today. And before we do anything else here, I do just want to quickly highlight where you can change those asset return assumptions on the client specific level. So this is going to be done within the gear icon settings area, in particular, the return assumptions tab. So you'll find the exact same layout here as you did in the advisor portal. The difference, of course, being any changes we make here are going to be specific to this client household. So, maybe just as an example, I wanted to use a slightly more conservative set of assumptions for just this client. I can either customize these myself or, choose to use the forward-looking assumptions here without impacting my global assumptions or any of my other client plans. Right. While we're here in the settings, I do also want to highlight that the methodology tab here is where you can find that allocation method setting at the client level as well. So it's in the exact same location as it was within the client presets tab. And of course, we have the exact same options to choose from here as well. As I mentioned, this setting determines our client's long-term investment strategy, essentially. How are we going to project that client's asset allocation out into the future within the financial plan? But of course, before we can project a client's asset allocation into the future, we first have to establish the client's current allocation, how that client is invested today. So asset allocation in RightCapital really starts within the profile net worth section here. This is, of course, where investment accounts are entered within RightCapital along with their balances. And this is part of the initial data entry process as well. So, as we're entering clients' assets into their client plan, we can individually allocate those investments to determine the client's current allocation. So I'm just going to add a new investment account here just to demonstrate some of the options. So I'm going to click Add Account in the upper right, and then choose the investment option to add a new investment account to the plan. When it comes to asset allocation, there is a menu here at the bottom of this drawer that you can click to open the asset allocation for this account. And depending on how you're entering the account, the options are going to vary a little bit. So firstly, dependent on the entry method, how we're entering that account into RightCapital, this will change a bit. So when we're entering the total balance of the account, let me just enter a balance here. So we have some numbers in there. When we go to allocate that account, we'll have two different options. We can either customize the allocation manually by entering in the percentages for each asset class here, And then, of course, the other option would be to choose a model portfolio to base the allocation of that account on. So you will find a full list of the default model portfolios in RightCapital here, as well as any custom models. So if you have already built some custom models into your RightCapital account, or if you've imported some models from an outside source like nitrogen, those will appear here as well, and we can choose to use one of those to allocate this account. I do want to quickly highlight that if you are using the other entry method to create that account in RightCapital, which would be the enter holdings / asset class model, it does change a bit. Of course, with this entry method, we are adding individual holdings and asset classes to determine the value of the account here. And this is going to pull in the allocation information automatically from Morningstar. So by default, the allocation of these accounts is going to be pulled in for you based on, of course, the holdings that are entered into the account itself. So by default, the asset allocation will be based on the holdings and asset classes within the account, which does sort of save you a step there in terms of having to manually allocate the account yourself when you are building these out with specific holdings. But if for any reason you ever need to overwrite the Morningstar allocation for the overall account, you can still choose these other two options. So you can always overwrite that with a model portfolio or a custom allocation if you'd like. Perfect. Now that we've covered the entry methods here, I do quickly just want to take us into the investment module in RightCapital. And the reason for that is that once we've entered all of the client's investments and allocated those appropriately, the allocation tab here is where we can find the rate of return and the asset class breakdown for the client's current allocation on the left here. So generally speaking, this current allocation, when we're looking at all accounts here, is a blended overall allocation of all of the non-annuity investments within that client's plan. So we get a big picture sense here of the client's equity fixed income split. We can see that percentage breakdown by asset class here. And importantly, we can see the annual return percentage as well, which of course is going to be somewhat dependent on your return assumptions that we looked at a few moments ago. So when we're looking at the current allocation here, I do want to point out that in addition to all accounts, we can also choose to use a specific combination of accounts as well. So I did neglect to name these accounts, which is why they all say investment account here, but ideally we would have some good practices in terms of naming these accounts based on the account type, and we can choose to look at the allocation for a specific account or a specific combination of accounts, maybe just the taxable accounts, for instance. So you have a lot of flexibility here in terms of what we're actually looking at within this pie chart here. Perfect. The next thing I want to quickly look at is the allocation path tab next to the allocation or the asset allocation tab here. And this is really where we can start to visualize changes in that client's asset allocation over the course of the client's plan. And this is, of course, based on that allocation method setting that we looked at a bit earlier. So I am currently using the default option within this plan, which would be the same allocation for all years. So we can see that there are currently no changes in this client's allocation over time. It's simply using the current allocation, the current rate of return as the long-term rate of return within the plan. But as we saw, there are two additional options for us to choose from for the client's allocation method. And those are going to change what we see here and what we see within the retirement projections and the probability of success as well. So let's pivot back into our gear icon settings methodology tab and take a look at those other two options here for the allocation method. The first option here that I want to take a look at is going to be this pre and post retirement allocation option. And with this option selected, we essentially get to choose two different portfolios for pre and post retirement. So with this option, we will see a hard switch in the year of retirement between allocation 1 and allocation 2. So this is the first option that we have here. When you select this option for the allocation method, it will give you an additional field to specify the post-retirement allocation for the current plan. So the pre-retirement, of course, is going to be based on the client's current allocation, how they're invested today. But for post-retirement, we can choose here what we want the current plan to use. So maybe we want to base that on just a general conservative portfolio here. We can select that as our post-retirement allocation for the current plan. And once we dial that in for our allocation method, we can pivot back to our investment allocation path tab and see the impact of that setting on our allocation over time. So here we see that hard switch from the current allocation to that conservative model from age 67 to age 68, which is when this client is retiring within the current plan here. And with this option selected, we essentially see the projections use two different rates of return within the plan. In pre-retirement, that's going to be our current allocation, which again, we can find the rate of return for that in the asset allocation tab here. So that 8.4% in pre-retirement. And then if we wanted to see the rate of return for that conservative model we selected, we can find that here as well. So in pre-retirement, we'd be using an 8.4 in this case, and then shifting to a 5.9 in the year of retirement and beyond. One additional thing to note here, while we're in the asset allocation tab, this will even show us the steps necessary to rebalance the portfolio here as well. So within these action items at the bottom of this page, we can see what would need to change in order to get us from how the client is invested today to how we want them to be invested in retirement. So in this case, it looks like the client would need to reduce US equities, increase US bonds and cash, with some other changes necessary here as well. So just keep in mind that is located here within the action items. Perfect. So the next option that we're going to be looking at here is going to be the glide path option. So let me click back into our gear icon settings, methodology page, and then we can select the glide path option for this setting. So with this option selected, what we're going to see in the plan is a more gradual transition in the client's allocation, from where they are today to a different allocation over time. Generally, that would be a more conservative allocation as time goes on. So that is what we see with the default glide path here. I do have a couple custom glide paths built out as well, which we will get to in just a few minutes here, but with the default glide path, this is built into every RightCapital account as a starting point for you. And specifically, this is going to see a transition from a 90-10 to a 50-50 split in the year of retirement, and then from that 50-50 to an 80-20 over the course of the next 20 years or so. So this is sort of a one-size-fits-all glide path that's available for you. You'll also notice that when you choose the glide path option, it's going to ask you for a grading schedule as well. And what we see here is, this controls specifically how long it's going to take for the client's current investment allocation to transition to match the glide path allocation. So just to explain that another way, essentially, how long is it going to take for us to get from 100% what's listed in the net worth section to 100% invested in the glide path strategy? So I'm actually going to show us the visual differences between some of these options, just because this is a more difficult aspect to wrap our heads around sometimes. So I'm going to select 1 year grading for now to start. So what we're going to see when we pivot back into the allocation path tab is it's going to be snapping immediately from the way the client is invested today in year 1 of the plan to the allocation set by the glide path in year 2 of the plan. So that's what we see here in this first year, is that snap from current allocation to glide path allocation. And then we're simply following the default glide path allocation for the remainder of this plan here. So we see that gradual transition from, like I said, 90-10 to 50-50 in the year of retirement here. And then by the end of our glide path, we level off at that 20-80. I'm going to open back up a separate tab here and select a 40-year grading schedule, and then compare, just so we can see the visual differences between those two options and hopefully better understand exactly what that's doing in terms of asset allocation. So I'm going to switch this from 1-year grading to 40-year grading here. So this is the most gradual option. It's going to slowly match the client's current allocation to the glide path allocation over a 40-year period. And if I click back into the investment allocation path tab, we no longer see that immediate snap. We instead see a much more gradual, slowly descending glide here. And if we click back and forth between the 1-year and the 40-year grading, we can really see how drastic that difference is. Obviously, I did select the two options there on opposite ends of the scale, so this is as drastic as it will get. But I find that this can be helpful to sort of better visualize what the grading schedule is doing within the plan here. Perfect. So those are all three options available within the allocation method setting. The next thing I want to dedicate some time to is specifically looking at creating custom glide paths and custom model portfolios. Because, of course, while the default portfolios and the default glide path can be useful as a starting point, the custom models are really what give us more granular control over what we see within these plans. So I'm going to pivot back into the advisor portal here, and then I'm going to click into the models portfolios tab to start. So this is where we can view all of the existing portfolios within our RightCapital account. And this is also where we can create additional model portfolios as well. So I'm going to click add portfolio here in the upper left to create a new blank slate portfolio. And the process here is essentially the same as what we walked through a bit earlier when allocating accounts in the profile net worth section. So to create a custom portfolio here, you have two options in terms of the model type. The asset class based model type is essentially that custom option that we looked at within the plan itself. You can manually enter your percentages here for each asset class. And as long as those add up to 100%, you'll be able to save that portfolio. And of course, by clicking the pencil and paper icon at the top here, we can save, we can rename these however we'd like. So maybe we want to call this custom 60/40 portfolio, and then that will be saved and available for use within the client plan. The other option, of course, is the holdings-based model. And again, just like within the client plan itself, this is going to let us build out our custom model with specific holdings. So by clicking that edit holding button, you can begin adding holdings to this account. And of course, once that reaches 100%, you can again save that portfolio, and that allocation will be curated for you based on the Morningstar allocations of those holdings. Something I always like to highlight here as sort of a pro tip: if you are using the the model type for asset class based, whenever you create a new portfolio here, it does default to the 60/40 model just as a placeholder for you. But the easiest way to actually zero out all of these fields is to actually switch this to holdings based and then switch it back. And that's going to simply zero out all of these fields, which can definitely make things a little bit easier if you're going to enter custom percentages for all of these. Perfect. So the next thing we're going to look at here is creating custom glide paths. So, of course, we have our default glide path here. This one can't be adjusted, but it can still be useful as a reference if you want to see the details of what's happening here over the course of this glide path. As I mentioned, starting at that 90-10 split, slowly transitioning to that 50-50 in the year of retirement, and then that 80 or 20-80 rather by the end of our glide path here. So something I do want to mention with the glide path schedule, in particular, these are meant to be used across multiple clients, regardless of the specific age that a client is retiring. So, when you're creating these custom glide paths, you'll see a years to retirement column on the left. And, these positive numbers counting down are the years of pre-retirement. Year 0 listed here is going to be the year of retirement. And our negative numbers here are the years after retirement. And this is going to sort of dynamically adjust to fit whatever the retirement age is of the plan that you're currently working on. So maybe you have a client who's retiring at age 65, implementing the default glide path, for instance. Year 0 would be the year in which that client is retiring, age 65, and the rest of these years are going to be focused around that. Perfect. So when it comes to creating custom glide paths, you can click the Add Glide Path button in the upper left to add a new path here. Um, if you've been around with RightCapital for a little while, you may remember that previously you would have been required to sort of enter the percentages for equity, fixed income, and cash for each year of the glide path. And that is something you can still certainly do if you'd like, but recently we did add a quick fill button in the lower left here, which will save you a significant amount of time when it comes to creating these custom glide paths. You can very quickly and easily clear all using this quick fill button to zero out all of our fields here. And there is also an additional quick fill option to interpolate values as well, which is going to make things a lot easier if you're trying to fill the gaps between two sets of values. So just as a quick example for us here, I'm going to enter 90/10 and 20/80. Actually, let me throw cash in here as well, just for completion's sake. Perfect. And then if I click Quick Fill Interpolate, that's going to fill the gaps for us between those two sets of values. So, we see that descending equity column, that increasing fixed income column, and increasing cash column to fill the gaps from that 90/10 down to that 20/80 at the end of our glide. So just remember that this quick fill button is here for you as you're creating custom glide paths. It's certainly going to save you quite a bit of time. When it comes to creating custom glides in RightCapital, I do find that advisors tend to take different approaches here. Some will tailor their custom glide paths to specific clients. Others will create more general glide paths for specific demographics or client groups, and some will do both. So, you really have a lot of flexibility here when it comes to creating these custom glides. Perfect. So now that we've looked at creating some custom models here for our portfolios and our glide path, we are going to be pivoting back into the client plan here. And the next thing that we're going to be looking at is proposing new options within the retirement analysis section of the plan. So I'm going to click into the retirement section, which is going to take me to the retirement analysis. And this is really where we can say to a client that we want to recommend a different investment strategy. And this is really where we can show the value of that as well with the proposed plan on the left here. So, the asset allocation items within the action items drop down here are going to change depending on your chosen allocation method option in the settings. So we are going to be looking at all three of the different options here just to see what the changes are in the asset allocation drop down or drop downs in the action items. So I have a glide path implemented currently here, so we can see that we have an asset allocation item and a glide path item. So with the glide path option enabled, the glide path dropdown, of course, is the glide path that we're using within the current and proposed plans. I have the default glide path selected here for the current plan. Maybe I want to use the custom glide path for the proposed. And then the asset allocation item at the top here is going to determine the starting point of the glide. So if you want to use the way that the client is invested today for this comparison for both plans, you can leave this set to current allocation. But if you maybe have a custom portfolio that you've built for this client that you'd rather use as the starting point, for example, for the proposed plan, you can change the starting point of the glide path as well. So just as a side-by-side comparison here, we'll say that in this case, our current plan is going to be starting based on the way that the client is invested today and using that default glide path. Our proposed plan is going to be using a custom model that I've created and then using the custom glide path that I also created. And when I click refresh in the lower right, we can see the differences between the current and proposed with both of those options. Perfect. So I'm going to pivot into our gear icon settings tab here quickly, just so that we can switch to one of these other options and take another look. So I'm going to scroll back down to the allocation method. And the next one that we're going to look at here is the pre and post retirement allocation option. So I'm going to lock that one in here, pivot back to the retirement analysis. And again, we'll see some changes in the action items here. So now we see our asset allocation item once again, and a retirement allocation item. So of course, the asset allocation item is again going to determine that starting point, what allocation we'd like to use in pre-retirement for our current and proposed plans. And then the retirement allocation is whichever portfolio we're going to be switching to in the year of retirement for this proposed plan. So, again, we have our current allocation selected for both of these things currently, and then we can choose, two different models for our proposed plan for pre-retirement and post-retirement. And again, once you click refresh in the lower right, we're going to be able to see, the impact there, the differences in terms of probability of success and also ending assets as well. Lastly, we're going to take a quick look at the same allocation for all years option. This is the most straightforward, so we'll take a quick look at this one back in the retirement analysis tab. With that option selected, we simply have just the asset allocation option here, and that's it. So, with this option selected, we're of course using one rate of return, a single long-term rate of return within the plan. So, our current plan is using the client's current allocation and that current rate of return. And then for our proposed plan, we can choose a different model here, which will change the rate of return being used in the proposal. And like the other options, we can see the differences between our current and proposed plans. Something I do want to note here when it comes to changing asset allocation, specifically when we're looking at the probability of success. This is the Monte-Carlo analysis in RightCapital. So, with two different portfolios like this, volatility is going to be factored into what we're seeing here. So, even if you've implemented two different options here that have an identical rate of return, the volatility of those two allocations will be playing a role here. We will see the impact of that specifically on the probability of success and on the confidence chart, which is of course, really just a visualization of the probability of success here. So a more volatile portfolio is going to result in a wider range of possible outcomes here in the confidence chart, which can sometimes cause some dips in the probability of success. If we have a wider range, we might have some on the lower end that are dipping below that $0 line. So just something to be aware of, specifically with the Monte Carlo analysis. But if we are looking at the cash flows, for instance, which is going to be using a straight line linear growth projection, there is no volatility factor there. That's exclusively going to be looking at the rates of return from those allocations that we're using. Perfect. That does pretty much cover it for the content I had prepared for you today. Before transitioning into the Q&A, there are quickly a few more things that I do want to highlight here within this plan. The first thing being that we've been talking quite a lot about projected returns today. So I do want to quickly show all of us where we can find a client's projected portfolio return within the cash flows in particular. So in the retirement cash flows tab, you can always take a look at the projected returns going forward within the invested asset tab here. So within this column, or within this page rather, you will find a dedicated column for portfolio return. And this is where we can see the specific year-to-year returns for the overall investment portfolio for every year of our future-looking cash flow projections. So this can be a really useful look under the hood of what's happening in these projections, especially as we're playing around with different allocation methods and proposing different options. This will change quite drastically depending on your chosen allocation method. So for the most part, with the same allocation option, you will tend to see a gradual increase here in portfolio return as that compounds over time. With the pre and post option selected, you'll see something similar in pre-retirement with a dip in the year of retirement. And then with the glide path, that's the most different one here. That's typically going to look something like, maybe in the early years, we'll start by seeing more of an increase that will gradually level off or taper off over time, as we get closer to the end of the plan. So just keep in mind that you can always find the projected portfolio return within the invested asset section of the cash flows here. Last thing I'll say is that in terms of practical tips for actually presenting something like this to a client, facilitating these kinds of conversations, using RightCapital, a lot of advisors, in my experience, will sort of pivot back and forth between the investment module and the retirement module. The investment module, for the most part, is really meant to be informational. This is the visual backdrop, essentially, for those investment strategy conversations. And then the retirement module is really where we can see the impact of that new investment strategy. Run that Monte-Carlo analysis and compare current and proposed ending assets. So maybe just to give you a quick example here, we can start in our investment module. We can show a client here how they're invested today, what their overall portfolio is looking like, and what their projected annual return is looking like. We can compare that to our proposed allocation for that client, potentially a custom model that we've built for them. We can show them the differences here in terms of asset class breakdown, annual return, and even what changes they need to make to rebalance that portfolio. If we were using one of the other options here, we'd be able to see how that investment strategy is changing over time, whether that's a shift at retirement or a gradual transition over the course of the client's life. And then we can click into the retirement analysis. And this is where we can really show the client the impact that that's going to have on their overall financial plan. We can show them the increase in the probability of success and median ending asset value here. We can maybe take them to the comparisons tab where we can take a look at their invested assets over time between the current and the proposed plans, with and without our custom strategy that we've curated for these clients. So there's really a lot that we can do here to compare that current and proposed with different asset allocation options selected.